Imagine someone offered you a single euro. Just one coin. Would you throw it away? Probably. But what if that 1 euro had the potential to grow into 1 million euros? Sounds impossible. Yet mathematically, it isn't. The biggest obstacle isn't the amount of money you start with. It's the mistakes that stop people from staying invested long enough. Today you'll discover why most people never build wealth, the incredible power of compound growth, and the one investing mistake that quietly destroys millions of financial futures. Let's be honest. 1 euro won't magically become 1 million overnight. There is no secret app, no guaranteed investment, no hidden trick that financial experts don't want you to know. The real secret is something far less exciting, but far more powerful: time. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, though historians debate whether he actually said it. Regardless of who said it, the idea remains incredibly important. Money that earns returns can, over time, generate returns on those returns. That's compound growth. Imagine rolling a tiny snowball down a hill. At first, almost nothing happens. But as it rolls, it collects more snow. It gets bigger, heavier, and faster. Investing works the same way. In the early years, progress feels painfully slow. Then, something remarkable happens. Your investments begin doing more work than your own savings. Eventually, growth accelerates. If compound growth is so powerful, why doesn't everyone become wealthy? Because most people interrupt the process. They panic when markets fall. They chase quick profits. They constantly buy and sell. Or they simply quit too early. Every time you stop investing, you reset the snowball. Imagine investing for 10 years. Then the market drops 25%. Fear takes over. You sell everything. Months later, the market begins recovering. But you're sitting in cash. You've locked in losses and missed the recovery. Historically, some of the market's strongest days have occurred shortly after major declines. Missing just a handful of strong recovery days can significantly reduce long-term returns. This is one reason many long-term investors focus on staying invested instead of trying to perfectly time the market. Many beginners ask, when is the perfect time to invest? History suggests a different question. How long can you stay invested? No one consistently predicts every market top and bottom. Even professional investors get it wrong. The greatest advantage most people have isn't perfect timing. It's patience. Many people delay investing because they think they need thousands of euros. But starting matters more than starting big. Small, regular contributions can grow over long periods, depending on investment performance. The habit often matters more than the initial amount. There's another mistake: leaving all your money sitting in cash for decades. Inflation slowly reduces purchasing power. Even if the number in your bank account stays the same, what that money can buy may decline over time. That's why many people choose investments that aim to outpace inflation over the long run, though all investments carry risk. Imagine putting every euro into one company. If that company fails, your savings could disappear. Now imagine spreading your money across hundreds or thousands of companies. That's diversification. You reduce the impact of any single investment performing poorly. Many investors use diversified funds to achieve this, though there are different approaches and each has its own risks. Building wealth isn't usually about getting lucky once. It's about making good decisions repeatedly. Spend less than you earn. Invest consistently. Stay patient. Keep learning. Avoid emotional decisions. Those habits may not look exciting, but over decades, they can make an enormous difference. So, can 1 euro really become 1 million? Mathematically, small amounts can grow dramatically over long periods with consistent contributions and investment returns, but there is no guarantee, and real-world results depend on many factors, including risk, market performance, and time. The real lesson isn't about 1 euro. It's about starting. Because the biggest investing mistake isn't beginning with too little money. It's waiting so long that time is no longer on your side. The earlier you begin learning about money, the more opportunities you give yourself to benefit from long-term growth. If you enjoyed this video and want more simple explanations about investing, personal finance, European markets, and building long-term wealth, subscribe and turn on notifications. Thanks for watching, and I'll see you in the next video.